This is Bill Hwang. He's not a YouTube finance bro or a Reddit meme trader. He's the guy who quietly built a $30 billion fortune and then vaporized $20 billion in 2 days. He didn't run a flashy hedge fund. He didn't have celebrity investors or a podcast. What he did have was a family office, a pile of borrowed money, and Wall Street's full trust, and that was more than enough to blow up half the global banking sector. One man. No outside investors. No risk officers watching over his shoulder. And somehow, he fooled Morgan Stanley, Goldman Sachs, Nomura, Credit Suisse, all at once. This is the story of how Wall Street's smartest people got played by a guy they should have never loaned $1 to, and how a single margin call triggered one of the biggest hidden financial disasters of the decade. On paper, Bill Hwang should have been blacklisted from finance. In 2012, his first hedge fund, Tiger Asia, got busted for insider trading. Not just slapped on the wrist, but banned. He was barred from managing public money and paid tens of millions in fines. But Bill didn't disappear. He just changed the rules of the game. He shut down Tiger Asia, rebranded himself, and quietly launched a family office, Archegos Capital Management. No public reporting, no regulatory oversight, just Bill trading with his own money and eventually billions more that didn't belong to him. Archegos was built to move in silence and take massive bets. If this feels like a redemption arc, it wasn't. It was a revenge arc, the kind where the guy gets kicked out the front door, sneaks in through the basement, and ends up holding the deed to the building. By 2020, Bill was back on Wall Street's radar, but not in the headlines. Banks were lining up to lend him money. Why? Because he was generating huge returns, and because none of them knew how much exposure he really had. Bill didn't trick the system, he just played it harder than anyone else. The same system that once banned him had quietly welcomed him back with billions in leverage. And no one thought to ask, how big is this guy's position really? Archegos wasn't a hedge fund, at least not legally. It was a family office, a quiet private firm set up to manage one man's wealth. No investors, no board, no quarterly calls, just Bill Hwang himself. But here is the catch. Family offices don't have to tell anyone what they're doing. No Securities and Exchange Commission disclosure, no risk reporting. You could be managing $5 billion or 5 cents no one would know. So while Wall Street thought of Archegos as just another rich guy's portfolio, Bill was quietly building one of the most dangerous portfolios in modern finance. He wasn't spreading his money around like a typical investor. He was going all in, taking huge positions in a handful of stocks, media companies, Chinese tech, and a few US names. Names you'd barely notice if you weren't paying attention. And no one was actually, because Bill didn't buy these stocks outright. He used something far more opaque, total return swaps. With a total return swap, Bill could make a huge bet, hundreds of millions at a time without ever actually owning the stock. The banks bought the shares for him, lent him the money, and in return, he paid them fees and interest. On paper, it looked clean. To Goldman, he looked like a loyal client with a $5 billion position. To Morgan Stanley, same thing. To Credit Suisse, no red flags. No one knew they were all backing the same trades. Bill had engineered a ghost portfolio. And since swaps don't show up in public filings, none of the companies he was betting on or betting against had any idea either. This wasn't a hedge fund operating in the shadows. This was a shadow of a hedge fund. No transparency, no oversight, and no breaks. Archegos wasn't just risky, it was invisible. And by the time anyone noticed, it was already too late. Total return swaps sound complicated, but they're really just smoke and mirrors, Wall Street's favorite kind. Here's how it works. Instead of buying a stock himself, Bill asked the banks to buy it for him. In return, he would pay them interest. And if the stock went up, he would keep the profits. If it went down, he would cover the losses. Simple idea, but terrifying in practice. To the outside world, Bill didn't own anything, and the banks didn't realize they were holding the exact same positions on behalf of the same guy. It's like lending money to a gambler who never tells you how many other bookies he owes. With each swap, Bill could multiply his exposure, 5 times, 10 times, and far beyond what any normal investor could pull off. The beauty of the swap is that no one saw it coming, not even the companies he was piling into. This was Bill's magic trick, and it worked until it didn't. By early 2021, Archegos had quietly become one of the most aggressive trading forces on Wall Street. It was placing multi-billion-dollar bets on a handful of stocks, including Viacom CBS and Chinese tech firms, using borrowed money from major banks. Each bank saw strong returns and no red flags, unaware that Bill Hwang was making the same trades through all of them. As the stocks surged, his exposure rose well past $100 billion. The system rewarded him for winning, so they kept raising his limits. No one asked how concentrated the risk was. Then Viacom announced a surprise stock sale. The price dipped, and with it, the first crack appeared. The unwinding had begun. Viacom's dip triggered a margin call. Archegos couldn't meet it. The banks panicked, each rushing to dump Bill's positions before the others could. It turned into a fire sale. Tens of billions in stock unloaded within hours. Prices crashed. Archegos was wiped out. Credit Suisse lost over $5 billion. Nomura, $2.9 billion. In total, more than $20 billion vanished. No fraud, no crime. Just too much trust in one man with no one watching him. In the aftermath, banks scrambled to explain how they'd been blindsided. Credit Suisse fired top executives. Nomura slashed its trading operations. Regulators opened inquiries, but nothing stuck because technically nothing illegal had happened. Archegos declared bankruptcy. Bill Hwang disappeared from public view, offering no apology, no interviews, no defense. Behind closed doors, Wall Street treated it as a freak event. But the truth was harder to admit. They handed him the matches, then acted surprised when the house caught fire. Archegos wasn't a fraud. It was a failure of incentives. Bill Hwang took as much risk as the banks allowed. And the banks allowed everything. No one asked questions because everyone was making money. Family offices like Archegos face almost no regulation. Total return swaps are barely disclosed. Risk was sliced up and passed around until no one knew who held what. The system didn't break. It worked exactly as designed, right up until it didn't. And there's nothing stopping it from happening again. Bill Hwang isn't just a cautionary tale. He's a convicted felon. In 2024, a federal jury found him guilty of market manipulation and securities fraud. He was sentenced to 18 years in prison. It's one of the harshest punishments Wall Street has seen in decades. But the story doesn't end there. The banks that enabled him are still operating. The loopholes he used are still open. Archegos was a disaster, but not a unique one. It revealed just how much money can move in silence, and how little it takes to bring the system to its knees.